Welcome to Modern Wealth's quarterly update. I'm Stephen Tuckwood, Director of Investments here at Modern Wealth, and I'm pleased to be joined by Neal Falkenberry, Managing Director of our Reston, Virginia office. Hey, Neal, how are we doing?
Doing well, Tuck. How about yourself?
Doing great. It's been a very, very interesting quarter and start of the year here. So really just wanted to get our viewers up to speed with all the goings on and really wanted to focus on the equity market to begin with. We're here at all-time highs, remarkably. So I think just getting everybody up to speed on the story so far would be quite worthwhile. So we've put some slides together. The first one here is the monthly return chart for the S&P 500, which is a good proxy for the US equity market. And you can see that during the second quarter of the year, we're up almost 11%, 10.9, after two great months in May and June. It's been a difficult start to the year. Q1 was troubled as we went through various different crises there, but somehow rebounded. And so far this year, we're up just over 6% on the equity side. To put that 10.9% into context, we've shown here the distribution of quarterly returns over the last 20 years. So this is 80 different quarters of the last trailing 20 years of data. And you can see highlighted in green is the Q2 performance of 10.9%, which is right between the 10 and the 11 percentage points of gains. And, you can see it's somewhat of an outlier here. We don't typically get quarterly moves this large on either the upside or the downside. But it just goes to show you that after following a negative quarter, big positive quarters can sometimes follow, and more reason to stay invested along the way. A picture tells 1,000 words. So here's the S&P price index over the last 6 months. And you can see it really was a tale of two quarters. Q1 started off well. We're up almost 4%. And then we got some news out of China from DeepSeek, really testing the AI trade. And there was a bit of a sell-off there, and then continued by a big sell-off on Liberation Day, which I'm sure everybody's heard about at this point, where tariffs were announced across the board. And we had a big decline in the market, only to be met by a 90-day pause there on April 8th and 9th, which kicked off really the second half of this period, and we were off to the races again. So really dramatic first half of the year, really different Q1 and Q2, and ended up just over 6% for the year so far. As we look under the hood, we can take a deep dive into the sectors and see what was powering Q2's performance. On the left-hand side is the sector weights of the S&P 500 according to Morningstar. And you can see just how dominated the index is by technology. It's about a third of the index at this point. And Neal, I'm sure we can dig into just how concentrated things have gotten there, both from a individual stock perspective, but also a sector perspective. But certainly what technology does really does drive the quarter. And that's what happened in Q1 and Q2. You can see there on the right, the contribution of the index's return. So of that 10.9% for Q2, 7.1% of that came from the technology sector, which had a really strong quarter, up 22.8% for that period. So certainly doing a lot of the driving again, and somewhat feels like a repeat of the latter stages of last year.
Tuck, it really does seem like a disproportionately high contribution from technology, but in some ways it seems like we should be thankful, because I think really last year tech's contribution was closer to 130%, right? I think the average stock outside of tech really struggled last year with returns. So maybe counter a blessing that the market has broadened out just a little bit from tech, even though clearly tech's driving returns right now.
Absolutely, yes. I think we'll take it for now, but maybe some cause for concern that we can talk about later. Looking at things through more of a factor lens, value versus growth, with tech having such a strong quarter, it's no surprise that the large cap growth space, measured here by the Russell 1000 Growth Index, was up almost 18%. And that really did catch things up for that side of the equation from Q1. And year to date, it ended up that it's flushed out. Value and growth are pretty much neck and neck, at least according to these two indices. Small caps still trailing, both on the growth and the value side, which is a point of interest there. Neal, as you think about small cap companies versus the large cap, is that a barometer for the health of the general economy here, or anything to think about?
Yeah, Tuck, I think small cap companies starting to outperform is again another sign that the market's broadening out just a little bit. I think that's a sign of confidence that the market's not just concentrating in a handful of high, large cap tech stocks that have highly visible earnings. That the market's now broadening out, buying more of these regional companies, and generally that's been a pretty strong vote of confidence in the health of the economy.
All right, let's look overseas because that's been a really interesting story as well. And the parts in blue here on the different countries, it's the different countries' indices, their stock markets. The portion in blue is the performance of that country's index in Q2, and then we have a year-to-date number in the brownish color underneath it. And you can really see there's been some very strong moves higher this year, right across the board outside of the United States. What should we take from this, Neil? That the fact that we finally have ex-US companies leading the way here in 2025.
Yeah, leading the way by a large margin. I think we spend so much time thinking about the health of the economy, driving corporate profits that ultimately drive stock returns. But look at some of these countries. Germany, for example, up 34% this year. Germany's had two quarters of positive GDP growth in 2 years. Current GDP growth is negative, minus zero point 0.2. France up 20%. Growth has been very close to zero. Same thing in the UK. Japan up 11%. Growth there has been 1% really for forever. So when we get these shock events in markets around tariffs or whatever the issue might be, I think the market goes looking for safety, maybe looking to leave some of the very high valuation names that from the U.S. that drove such returns in 23 and 24, and we go looking for value. And Germany trades at 16 times earnings, the UK at 13 times earnings, Japan also about 15 versus 27% for the US. So stock returns are not always about GDP growth. We spend so much time talking about the health of the economy, but oftentimes it's a shock that drives the market to value. Tuck, I know we have clients of the firm that watch this episode as well as non-clients of the firm. So clients of the firm will know that we're a big advocate, big believer in diversifying equity portfolios, not just in the U.S. from large cap and small cap, but including large cap and emerging markets. And you're a big proponent of that process, and it has worked really so well this year. I think it's really remarkable, not only the help that we got from that international diversification, but the help came right when you needed the help to come. Right
Yep.
in the first quarter, when U.S. returns were negative, these non-U.S. markets were still up almost double digits in some cases. And I think that helps our clients stick with their financial plans, that we smooth out that volatility through portfolio construction. So really, really a very good example of kind of a decoupling of the economy from equity returns, but a real big statement, I think, about the benefits of equity diversification.
Yeah, I couldn't agree more. And it really also reminds me that you never know when things are going to turn. And the valuation gap between the US and ex US stocks was quite wide and had been that way for quite some time. And it takes a catalyst, as you mentioned. In this case, it happened to be the tariff announcement and then also some news about defense spending and fiscal policy there in Europe. And we just never know when those things are going to come around, when that's going to get ignited. So, to your point, really important to continue to be diversified because that's an acknowledgement that we don't know what the future holds.
Yeah, I think it also takes a lot of belief in your process and your research, right? Last year, it was so easy to concentrate in the Magnificent Seven, those seven tech stocks that NVIDIA and Google and Microsoft and whatnot. It took a lot of discipline to follow that value that you just mentioned and buy these companies or countries with much lower multiples. And again, if you stay with that discipline of buying value over time, we know that works. So you're right to your point. You never know when it's going to happen, but stick to your disciplines, and good things generally happen from that process.
Well, let's pivot now to the fixed income market and talk about what kind of year we've had so far there. So here's different fixed income indices. The Q2 numbers are in blue. The year-to-date numbers, the returns are in gold. And you can see generally positive in both periods for broad fixed income here. The aggregate bond, most people think of that, the AG, is on the left-hand side, so up 4% for the year, but all different sectors doing pretty well as well. So we've had spreads here that have widened a little bit during the tariffs, but nothing got too extreme. So, kind of where we were at the beginning of the year. And the long end of the curve has lowered a little bit as well, which has been a nice tailwind for fixed income here. So decent returns. And again, just back to diversification. If people are remembering back to 2022 when fixed income didn't help us in that regard, it wasn't a time to throw the towel in, but rather let's stay disciplined and continue to have thoughtful exposure to various fixed income. And this year, it's also proven to be somewhat of a ballast during those difficult times. If we dial in just to the 10-year Treasury yield, which a lot of these fixed income indices are operate against, um, there's a 20-year chart here for the 10-year Treasury yield, and you can see how that has had quite a good run of moving from the upper left to the lower right, which has been a real tailwind for fixed income in general. Those rates just gradually moving lower. There was a pivot there as the Fed started to raise rates, so that was the 22 period that spiked us higher, and now we've been in this range of 5 to 4% ish on the 10-year Treasury, and we've zoomed in there on a year-to-date basis just to see that range-bound nature of it right now. Last month or so, we've again enjoyed that move lower from 4.58 down to just around 4.2-ish right now. But the 10-year yield is really something that I think the markets have been keyed off of this year. And my one of my thoughts is, I'd love to get your thoughts on this, Neal, is that during the difficult time in April when the stock market was declining to the extent that it was because of the tariff announcements, the 90-day pause perhaps came from a conversation with the president and the Treasury Secretary in terms of saying, hey, interest rates are actually shooting higher here, and this could really hurt us if they do move materially above 5%, just from servicing the debt load that we have here in the United States. How do you agree, Neal, that the Treasury Secretary is kind of dialed in on the 10-year rate, and that's really been a focus of trying to work that down just through comments to the media and such?
Yeah, absolutely, Tuck. I think that I'm referencing now that low of right at 4% in that magnified box there on the chart. This is why we got a 90-day pause in the tariffs. It wasn't some other belief around global trade policy or conversations with international leaders. It was the 10-year Treasury going from 4 to 4.5 in 3 days, where we find out now that Trump has opposition. It may not be in the House, it may not be in the Senate per se, but it is definitely there in the bond market. And I think that's comforting, and not making a political statement here, but the bond market is governing exactly the degree to which policy can be implemented either hastily, sloppily, or perhaps an era, or just the magnitude of debt now that's being issued. That the bond market is paying attention and is a governing entity on exactly what we can get away with. And I think this is clearly what drove Trump to offer that 90-day pause in tariffs, and that then turned out to be the bottom in the equity market. Tuck, but if you zoom back out, outside of that drama around tariffs, it's still pretty remarkable that bonds have been range bound here between 4 and 5%. And while we have this equity market sell off of near 15% at one point during the year, and now the recovery back to new highs, the wise bond market has been here very patient, pricing in forward inflation, adjusting higher from where long-term rates used to be, and now taking a very long-term view about inflation, maybe not going back to as low as it was back to the 2% Fed target, but that it might be 2.5%. It's going to be a little bit higher, but it's not going to be 3.5%. And now rates are off to the races, and that tariffs are going to be a hyperinflationary event. I'm really impressed by the bond market's ability to look through the noise that equities perhaps did not so far this year and even going back maybe for the last year.
Hmm. Yeah. Yeah, it strikes me that the fixed income market might be the cooler-headed one
Absolutely.
versus the equity market that tends to react more emotionally to
Yeah, the
things.
bond market has all the gray hair, and the stock market's more the petulant teenager, I think.
Yep, yep. Well, talking of interest rates, let's move now to the short end of the curve. This is the federal funds target rate over time, and going back here, back to 1995. And the highlighted pieces in red are the beginning and the end of a rate cutting cycle of the Fed, and often overlays with periods of recession. That tends to be when they do cut. But this has really been a remarkable story. You can just see the degree of uplift that we got in 2022, just quite dramatic to me, just what a rate hiking cycle that was historically. Quite dramatic indeed. So, we've obviously weathered that and gone through that. And then we've had a period where they paused at 5.5% and started to lower that rate in September of last year, a 50 basis point cut, followed by two additional 25 basis point cuts. And now we find ourselves at 4.5 as a upper target range. And it's been that way for the past four Fed meetings. So on the right hand side, we can see the calendar, the FOMC calendar, and we've been through four of those without a decision on rates. Obviously, a lot of different discussions, and the Fed has press conferences and such that they're able to communicate policy in certain ways through that. But at least the federal funds rate has not moved so far. That leaves us with four more meetings on the calendar. The Fed can always convene, in between those, but that would be quite extraordinary, and they don't typically do that. So they likely will stick to the calendar here and have four more. So that's four opportunities for them to change policy here and potentially cut rates. Um, we think about this a lot, and this has big implications for the rate of return that investors get on money market funds, on their bank savings and short-term T-bills and such. So, quite an important feature, and we've enjoyed quite nice rates over the recent past. But yeah, those could potentially be moving lower here. But Neil, what's as you kind of prognosticate here, what the Fed might do if you were in their shoes? Would you be cutting rates here, and how many do you think might happen over these next four meetings for the remainder of 25?
If you move to the next slide, we'll see what the bond market is now currently pricing. So that purple line is the current Fed funds rate of 4.5, and the orange line is now where Fed funds are trading going out into the future over the next, let's call it the next 18 months. Right now, the market's pricing a 25 basis point cut when the Fed meets in September, and another 25 basis point cut in the December meeting, probably reflected in early January. So that's two cuts. That would take Fed funds down to 4. Today, the 2-year Treasury, which is, I think, fair to say that's where the market believes the Fed funds rate should be, or where Fed policy should be, is currently at 3.75. So I think the market is pricing that the Fed has room here to cut, and perhaps cut even more aggressively than what's currently priced into the market. I think Powell clearly is concerned that the effective tariffs will take some time to work through the cycle, right? You have exporter to importer negotiating on who's going to eat cost and who's going to pass them on. You have importer to manufacturer, producer, who's going to have a negotiation on who's going to eat some of those costs and who's going to pass them on. And finally, the manufacturer to the consumer will have that same negotiation through competition and through discounting. It'll take time for that to work its way through the cycle. So far, CPI inflation has come down to 2.4. That's about where we were 3 months ago. It's come down a little bit. Producer price inflation is even a little bit lower than that. So there does not appear to be a lot of inflation in the pipeline. I think that bucks the trend maybe of the tariff narrative, that immediately it becomes inflationary to consumers. That was the experience in the first Trump term, that those tariffs were not inflationary. I think there's I think there's many more reasons why they could become inflationary this cycle. But I think the Fed is on hold here, waiting to see the effect of those tariffs before they start a additional cutting cycle. I think the Fed's worst nightmare would be to cut one or two times, see inflation perk back up, and now have to go right back to tightening. I think that would work against Fed credibility. So patience here probably through the summer. And then I could see more aggressive tightening into the fall, perhaps even more than these two cuts here.
Yeah, it certainly feels that way, that they are being cautious here, and like you say, backtracking potentially is something they do not like to do at all. So just waiting for that all clear that tariffs have not kicked up inflation again, I think is probably where their mind is at right now. So yeah, time will tell here. We'll obviously be watching that closely as these FOMC meetings come around on the calendar. So that's the fixed income market and the look forward. What about the equity market looking forward from where we are today? Um, we're up 6% for the year, and we were coming into the year really at stretched valuations. We talked about the big contribution from large cap tech that was the story of 2024. Had the big sell off in the first half of this year, and then the big rebound again driven by tech. So in many ways, we're kind of where we were coming into the year in terms of stretched valuations being led predominantly by large cap tech and those concerns that I think we'd shared on prior calls. Um, and now we've got some of the tariff noise. Obviously, a lot of that's been flushed out to some extent, but we have the 90-day pause expiring soon, which we'll look at that calendar in a second. But yeah, valuation-wise, specifically here, this is looking at the price return. So we're up to 6,200 on the S&P 500, and the last 12 months earnings that are on the books. So these are real materialized on the books, is $227 of earnings per share for the S&P 500 companies as a whole. And then that means what's the difference there? The P over the E is about 27 times on a look back basis. So that just gives us some historical context. But as we know, the stock market cares about the future and about future growth. And that leads us to the next chart, which is showing the current year, so 2025 earnings per share estimates for the S&P 500, and then 2026 estimates. So these are numbers that the market rarely keys off of, and the ability for the companies to deliver that is really important because, again, the equity market is very, very forward-looking, not rear-view mirror. So Neil, earnings higher from where they are, obviously, as things are shaping up here. A decent quarter on the books, which gives us a bit of confidence that there's some future growth there to come. But are valuations too lofty? Are earnings expectations too high? What's your guess here?
Like I like the expression you use that we're kind of back to where we were. And I think if you were just looking at data and particularly decoupled from politics, inflation's about where we started the year. Bond yields are about where we started the year. Stock market's about where it was. Unemployment's still low. Initial claims for unemployment they're rising a little bit. Some of the hard data is starting to get a little bit soft, but it's not yet at a point that's concerning. There's a bit of equilibrium, I think, at play in the market. And if we look at forward earnings estimates, they have been coming down. So the black line on this chart is 2025 earnings estimates. The blue line is 2026. So clearly 2025 estimates were declining all during 2024, but they've now bottomed and have started to perk up. Those numbers, if they come to be true, are about 12% earnings growth over where we finished last year. That's impressive. We had 7% earnings growth last year. If we get 12% this year, and then the distance from this year to next year is another roughly 13% earnings growth. We are clearly at high valuation multiples. 27 times earnings is about the market's only been more expensive, maybe 5% of occurrences at that level. But if we get 12% earnings growth, we don't really need earnings or multiple expansion. You would typically expect that if the Fed was cutting rates. But even if the Fed stays steady here, if the multiple stays the same and the market delivers that kind of earnings growth, we're still looking at a very nice, mid-teen level return for the equity market. And on the heels of great returns the last 2 years, I think we'd all be pretty satisfied with that, right? So there's clearly some risk to this. I would say, that we're following the analog of the last soft landing pretty well, and soft landings are pretty rare. We've of the last 10 rate hike cycles that the Fed has engineered, only 2 have ended in soft landing. The other 8 ended in a recession. And the last one that was a soft landing was 1994, and we saw fairly similar behavior we saw now. Markets went sideways for about 18 months, but earnings continued to grow. The market got cheap, and then we went on to rally to the dot-com peak. So I think there's a pretty good case here to be made that the market's not solely dependent on the Fed. And I think that's a great thing because I think we have been overly reliant on the Fed, either quantitative easing or continue to drive rates lower. I think we have an economy that's generating reasonable profits, and that bodes generally pretty well, I think, for the equity market, provided that, again, the employment data doesn't start to soften any further. But I think things look pretty good at the moment.
Yeah, I'm reminded of just the resiliency of the US consumer, resiliency of the US economy, and the US companies that are operating here, just their ability to
I
keep
I'd
growth.
also
Yeah.
add the resilience of Washington. I mean, it is, we're now gonna run a federal deficit of about 7% of GDP. We've been running them about 6% really since COVID. And if you think of the US economy growing 3.5% in a good year, we're borrowing 2 years' worth of growth to stick into the now. It's pretty hard to have a recession when you're doing that, right?
Mm.
And as long as the bond market allows that to take place without either believing we're going to repay that debt with dollars of lower purchasing power through inflation and rates have to go higher. It's in fact, we've never had a recession when we were running a federal deficit of greater than 5% of GDP. That bodes well, I think, for the equity market. It might not bode well for inflation, and maybe future generations could be concerned about that. But again, I think for this call for short term, that's a lot of support for the equity market.
We should perhaps have a dedicated call just on the long-term impact of the deficit and the growing debt burden here in the United States. I think that would be an interesting one, and we could spend quite a lot of time there. But it does relate back in the immediate term to the dollar, the US dollar, and we've experienced some significant weakness so far this year in the dollar versus any other currency, frankly. But that's had some implications. It's really helped the ex-US international stocks here. But this is a great chart comparing the two. You mind just walking us through this, Neil, and what you think the implications are?
Yeah, certainly. The blue line is the return of U.S. equities divided by the return of non-U.S. equities, right? So when that line is rising, U.S. stocks are outperforming the rest of the world. And when it's falling, as it is now and has been really all of this year, non-U.S. equities are outperforming. Then if we look on the panel on the bottom in green, that is the value of the U.S. dollar. And these periods like September of 2022, and again, all of this year, this outperformance of non-US equities is highly associated with weakness in the dollar. And so, when we build financial plans, we are trying to, as best we can, try to protect clients from risks known and unknown. And some of those unknown risks could be a weaker dollar because of continued large deficits or fiscal irresponsibility. I think it makes a lot of sense to have non-US equities in a portfolio in some weight as protection against this weaker dollar. And I think this really clearly shows that very tight correlation.
And yeah, it does link back to the deficit and concerns around that, and concerns around the United States' position in the world as the reserve currency. Lot longer trends there that we can get into certainly on another episode. just wanted to wrap things up. We couldn't end this update without a quick look at the tariffs because it is just all over the news, and wanted just to keep people really just sum it up and explain what the timelines are here. So, obviously there was the Liberation Day announcement on April 2nd, a rollback of that in a way, a 90-day pause, except for China on April 9th. May 11th was a separate conversation with China, and some agreement was reached there, which was also a big positive, and one of the reasons that the equity market, I think, was able to power higher. So a 90-day pause kicked off with China at that point. So we're coming up close to that first 90-day expiration. That's going to be July 9th. And there's been a few announcements of a few trade deals along the way, a few roadblocks as well, Canada specifically and others. So a few things to work out there. And then approximately, August 12th will be that 90-day pause with China. So obviously a big significant trading partner for the United States, and one that we'd like to see get resolved before that time. But ultimately, just where we are in the calendar here, this is being recorded on July 2nd. It doesn't look like every country will get a deal done by July 9th. I think it's pretty obvious at this point. And the market seems pretty okay with that. I think there'll be lesser traded partners that get done later. There's been some deals that have been done, as we mentioned. So, a bit of a mixed bag there, but that volatility, the market does not like surprises. So even though there might be some bad news here on the horizon in terms of July 9th coming without every trade deal being done, at least the market has a sense of that and can look to it, as opposed to what happened on April 2nd, where the market was surprised by the size and scope of the reciprocal tariff announcements. That's why we had that type of reaction. So, anything can cause a market correction in the short term. We can't predict any short-term market moves, and we know the market does a great job of growing clients' wealth over long periods of time, and the cost is short-term volatility, and that can come at any moment. So this is the outline. Neal, I didn't know if you had any quick thoughts here, or looking through this as well, like the market seems to be doing at the moment.
I think the important thing on tariffs, I agree with you, it can cause some short-term volatility, but I think Trump's negotiating style of proposing the big irrational and then settling for something much smaller, I think that card's now been played, and I really think we now know that the bond market's paying attention, and there's a limitation on exactly what can be done here. I'd be really surprised if we get the degree of volatility that we had in March and April around tariffs. There's plenty of other things that could cause volatility of that magnitude. I don't think tariffs are gonna be a primary volatility issue now. I think it's gonna move to the back burner, and it's gonna still be this dynamic of rates versus inflation versus corporate profits. And I think we're comfortable in that dynamic versus leaving tariff policy in one person's hand.
Yep. More back to the fundamentals. That
Mhm.
sounds good to me. Well, that's it for this episode. We really hope you enjoyed this. Neal, thanks for your time today and your insights. Always appreciated. And if anybody has any questions, please feel free to reach out here at Modern Wealth. And we look forward to chatting with you next time. Take care.